Users of this guide are advised to refer to the complete legislation or other applicable materials to ensure accuracy and comprehensive coverage of the material. Further, changes to legislation or administration actions that become effective after this date may make the information provided in this guide no longer current. This guide is provided to you for informational purposes only and should not be relied upon as legal or tax advice. Consult your legal or tax advisor for specific advice. Year-end preparation, what you need to know. Key points. Reconsider and review your withholding tax deduction. Make a right and tax-deductible charitable contribution. Maximize your 401k deduction. Utilize your FSA to the maximum extent. Harvest your expected loss. Consider wash sale rules. Defer your income to reduce tax. Withdraw required minimum distribution. Review and consider estate planning. Year-end preparation, look back your withholding tax. If you've experienced any significant changes in your career or personal life, such as a raise in salary, a shift in your marital status, the birth of a child, or the purchase of a home, it's vital that you review your current tax withholding. To ensure that the appropriate amount of taxes are being withheld from your paycheck, it is a good idea to review your withholding. If you don't withhold enough money from your paychecks, you could end up with a tax charge after filing your returns. Altering your tax situation to get more money in each paycheck may be preferable if you withhold too much and end up getting a huge tax refund. The IRS provides a self-service tool called the Tax Withholding Estimator that can help you determine if you have withheld enough money from your paycheck. To get started, you'll need to have access to your most recent pay stub and tax return. Year-end preparation, think about charitable donation. Contributing to a charity you care about before the end of the year might have additional benefits, including lowering your taxable income. Donations to charity are generally deductible only if you itemize your tax deductions. But to itemize, your total deductions must be higher than the standard deduction. When filing your taxes, the IRS permits you to deduct a standard amount called the standard deduction, regardless of your personal circumstances. As the government attempts to adjust for the biggest inflation in decades, it has been increasing standard deductions. The standard deduction amounts for the 2022 tax year, for returns submitted in 2023, are as follows. $12,950 for single and married filing separately taxpayers. $19,400 for head of household taxpayers. $25,900 for married filing jointly or qualifying widow, or taxpayers. However, before making a donation, verify that the charity of your choice is eligible to receive tax-deductible contributions. The Internal Revenue Service, IRS, provides a search tool where you may get up-to-date information about tax-exempt organizations. Year-end preparation, take the benefit of 401k contribution. A 401k retirement account contribution deadline is typically the later of December 31st or your final paycheck of the year. A maximum of $20,500 can be contributed that year. To the maximum of $27,000, an additional $6,500 can be contributed if you are 50 or older. Limits do not apply to employer contributions. There is a cap of $61,000 for 2022 on the sum of your and your employer's contributions. You need to take action immediately because December will bring your last paycheck of the year. Increasing your retirement contributions typically requires a conversation with your company's Human Resources Division. To make sure you haven't already reached the annual contribution limit, you should know how much you contributed this year. Year-end preparation, flexible spending account. Use it or lose it. A flexible spending account, also known as a flexible spending arrangement, is a special account you put money into that you use to pay for certain out-of-pocket healthcare costs. FSAs are limited to $2,850 per year per employer. If you're married, your spouse can put up to $2,850 in an FSA with their employer. You generally must use the money in an FSA within the plan year. But your employer may offer one of two options. Sad face 1, it can provide a grace period of up to 2.5 extra months to use the money in your FSA. 2, it can allow you to carry over up to $570 per year to use in the following year. As per https://www.irs.gov/pub/irs-drop/n-21-15.pdf, this rule temporarily is allowing carry the entire unused amount to next year. Year-end preparation, harvest your loss. Tax loss harvesting is when you sell some investments at a loss to offset gains you've realized by selling other stocks at a profit. The result is that you only pay taxes on your net profit, or the amount you've gained minus the amount you lost, thereby reducing your tax bill. Single filers and married couples filing jointly can deduct up to $3,000 in realized losses from ordinary income. Select this course of action if you are confident that your investment will not rise in value in the near future. Year-end preparation, wash sale rules. You can't, for instance, sell a stock to realize a loss and minimize your tax burden, and then rebuy that exact same stock, or even one that's nearly identical. This strategy is referred to as a wash sale. A wash sale occurs when you sell securities at a loss and within 30 days before or after the sale buy substantially identical securities or acquire a contract or option to do so. The wash sale rule does not, however, preclude purchasing securities in the same industry. For example, you can sell shares of Pfizer and replace them with shares of Merck. Year-end preparation, defer your income. By deferring, postponing, income to next year, you may be able to minimize your current income tax liability, if your future year tax rate is low. Here are ways you can achieve this strategy. Cash method of accounting. Postpone year-end billing. Installment sales. Interest and dividend. Year-end preparation, take RMD. Required minimum distributions, RMDs, must be taken from traditional IRAs and employer-sponsored retirement plans after the account holder reaches age 72. Exceptions may apply if the account holder is still actively employed by the plan sponsor. Withdraw the RMD by December 31st, the end of the tax year for most people. The penalty for not doing so is steep, 50% of the amount you were supposed to disperse but didn't. Beneficiaries are typically expected to take annual payments from inherited retirement accounts, and under the 10-year rule, with some exceptions for surviving spouses. Refer to Sure Financials and Tax Services LLC, Required Minimum Distribution, RMD, surfintaxsvs.blogspot.com, for more information. Year-end preparation, make an estate plan. It's a good idea to sit down with a financial advisor and go over your estate plans towards the end of the year to see if there are any ways you can save money on taxes or improve upon your current approach. The current $12.06 million lifetime gift and estate tax exception, in effect until 2026, may be a topic of conversation. You might also talk about whether or not it makes sense to set up a trust and fund it before the end of the year so as to take advantage of the tax benefits offered by the current legislation.
Meet Stanley. Stanley works really hard all year, but when it comes around to tax time, he gets worried. He doesn't want to lose more money to the tax man than he should. It all seems so complicated. Stanley never really knows if he's getting back, or keeping, what money is rightfully his. So this tax year, Stanley decided things will be different. He decided to find a qualified accountant who could make sure his taxes were done right. Thankfully, he found us. We can deal with all Stanley's tax affairs, even the complex stuff, because our staff are fully qualified, competent, and professional. We always make sure our clients receive everything they're entitled to, right down to the last penny. So now when it comes to tax time, Stanley doesn't have to go it alone against the tax man, and neither do you. Because with us on your side, you can be sure your financial affairs are in good hands. For complete peace of mind at tax time, contact us today.